With the much-promised surplus in tatters and a deficit clocking in at $19.4 billion, there are plenty of belt-tightening measures in this year's budget. So the big question is, how will it affect you? Hello and welcome to this budget-themed edition of The Bottom Line. Let's look at the good news first. There are no changes to personal tax rates, so taxable income ranges and tax payable for resident individuals stays the same as 2011-12 levels. However, to fund disability care, previously known as the NDIS, the Medicare levy has been increased by 0.5 percentage point to 2%. This means the average income earner is facing approximately $300 extra in tax per year, commencing July 1st, 2014. Individuals claiming healthcare deductions will now have to spend at least $2,000 a year on healthcare before they can start claiming, thanks to an increase in the Medicare safety net threshold from January 1st, 2015. From July 1st, 2014, deductions for work-related education expenses will be capped at $2,000. So if you're studying or thinking about taking up study in the coming years, speak to us to work out if the decrease in deductions will mean study is outside your budget. The superannuation industry breathed a sigh of relief with no major superannuation measures announced in the budget. Although pensioners will benefit from a $112.4 million trial to assist them in downsizing their home without affecting their pension. The government has extended the requirement to monthly pay-as-you-go instalments to all large entities, including trusts, superannuation funds, sole traders and large investors. Corporate entities with a turnover of $100 million or more will move to pay-as-you-go instalments from January 1st, 2015. Corporate tax entities with a turnover of $20 million or more will move to pay-as-you-go instalments from January 1st, 2016. And all other entities within the pay-as-you-go instalment system with a turnover of $20 million or more will move to monthly instalments from January 1st, 2017. While these entities won't necessarily be paying more tax, their tax schedules might change. So if this affects you, you'll need to ensure your finance team is across these changes. The government is closing a loophole that's enabled investors to engage in dividend washing. Currently, investors can engage in dividend washing to trade franking credits, resulting in some shareholders receiving 2 sets of franking credits for the same parcel of shares. After July 1st, 2013, when an investor engages in dividend washing by selling shares with a dividend and then immediately buying the same shares that still carry a right to a dividend, they will only be entitled to use 1 set of franking credits. The changes will be targeted to the 2-day period after a share goes ex-dividend. Chances are the 2013-14 budget will affect you in some way. So if you'd like further information on any of these budget items or have other accounting questions, we welcome your call or email. Thanks again for watching The Bottom Line.